What's going on, everybody? Kirk here with Tactical Options Trading, and in this video we're going to be talking about the VIX Index, also known as the Fear Index. So I got a question for you guys who trade options. Why, as an options trader, is the VIX Index so important for us to understand? So if you don't know the answer to that question, make sure you stick around. We're going to talk about why you need to know what the VIX is and how to use it in your options trading. So first things first, the VIX stands for Volatility Index, and what it does is it tracks the 30-day implied volatility of the S&P 500. It was created by the CBOE, or the Chicago Board Options Exchange, back in 1993. Now, I'm going to venture to say that there might be a few people on here who were born after 1993, but I'm going to say probably most of the people on this video were born before 1993, which we're in good company here. So why does the VIX track the S&P 500? Well, the S&P 500 is basically the market. So a little tidbit of information here. So as of January 2024, the S&P 500 index has a total market cap of more than $43 trillion. Yes, that's with a T. So that includes about 80% of the US public companies' market cap. So in other words, what I'm trying to say here is that 80% of the value of the US publicly traded companies is included inside the S&P 500. So yeah, it's a behemoth, and that's why we use the S&P 500. So if you don't know already, the ticker symbol for the S&P 500 index is SPX. So the VIX, what it does is it tracks the 30-day implied volatility of the options on the S&P 500 index. You know, when we're talking about implied volatility, multiple videos can be made just dedicated to implied volatility, of which I've done. But in short, implied volatility in options trading refers to the market's expectation of how volatile a stock's price will be in the future based on current options pricing. So when you look at the options chain here of the SPX, there's not a 30-day expiration cycle for each trading day. So you can see here that we have a 30-day, a 31-day, but then it skips a day or two here and there. So what the CBOE did, they actually used the expiration cycles for the SPX options that expire between 23 days and 37 days. So using the calls and puts inside these expiration cycles, they come up with an implied volatility number for each of these expiration cycles. Then what they do is they use a weighted average to come up with a 30-day implied volatility number, and that is what the VIX itself represents. All right, so I know that that was all really super technical, and I'd like to break these concepts down into understandable information that we can actually use. So what is the VIX actually telling us? As I mentioned in the beginning, it's a fear gauge, right? So you could almost call it the feelings gauge. So when you come into your desk in the morning and you're getting ready to trade options, you're getting ready to trade the stock market, you might want to ask the market, hey, how you feeling today? You feeling good? You feeling punchy? You feeling a little bit down? You feeling hot? You feeling cold? You feeling scared? You feeling okay? Well, how's the market going to answer that? What's the sentiment of the market? What it's going to do is it's going to say, hey, Mr. Trader, check out my VIX. Check out my VIX. The VIX is going to tell you how I'm feeling today. So the great thing about learning to trade options is that you get a little bit of an insight into the market that regular stock traders, I would say, just don't understand, or they don't even know exists. And if you're a stock trader and you check the options chain, I would say you're probably more of an advanced stock trader. So what do I mean by that? Well, let's just say that the market had a good run to the upside and you've made good money on your stocks. And of course, you don't want to lose what you've gained, right? We're all about those gains. So if you were just a stock trader, you could just sell your stock, right? But as an options trader, you could also hedge your positions with options in case the market decides to go south. So put options, as you know, were initially marketed as insurance policies on stock. When your stock has risen and you want to protect that, but you got that Amazon stock, or you got that Tesla stock that you just don't want to get rid of. You made some good money on it, but you don't want to sell it. So you could hedge your position by buying put options, or basically buying an insurance policy on your stock. So as traders become more and more fearful of a market pullback, they buy put options, and a put options gives you the right to sell stock at the price that you picked as the strike price. So options traders will buy put options to hedge their positions. So, it's kind of like farmers, how they insure their crops against adverse weather conditions. Investors use put options to protect their stock holdings from potential downturns in the market. And as we learned in economics class in high school, if you guys paid attention, right? Anytime there's a demand on something, well, what happens to prices? They go up. And as more fear of a pullback creeps into the minds of traders, the more put options or insurance policies are being bought up by options traders or stock traders buying options. So the more traders that are willing to pay for those options implies that they expect that the stock will move at least by the amount that they paid for those options. Otherwise, they would not have purchased the options for that price in the first place. This option pricing and what traders are willing to pay for options implies what traders are feeling and thinking or expecting the market to do. So hence, this is where we come up with the expected move. So how much do market participants expect the market to move? So the VIX Index is a 30-day snapshot of market sentiment during live trading hours that's updated every 15 seconds of where market participants feel like the market's going to be 30 days from now. So when you look at the VIX and it has a 14 or it's reading a 14%, that implies that over the next 30 days, the market participants expect that the SPX or the market will move 14% from its current price. So increasing VIX levels coincide with fear and uncertainty in the market, signaling a potential downturn. And also very high VIX readings could also mean that there's a bottom in the market. So many stock traders will look at this as an opportunity to buy stocks. So if you have a high VIX, a lot of fear in the market, we've had a big down day or down days in the market, it could represent a good opportunity to buy stock. But as an options trader, high VIX readings are a great environment for us to be an options seller, not a buyer of options, because we want to sell high and buy low. And when we're talking about options, everything is based on implied volatility. So if we have high implied volatility or the VIX is very high, we want to be a seller of options to open our trades and buy them back when that implied volatility shrinks, and we buy them back at a lower price. So high VIX readings means options pricing is expensive. That's why, again, we want to be a seller of options to open trades and buy them to close at a lower price. So in short, just kind of recapping everything here. In short, the VIX tells us how many traders are getting nervous or they're fearful out there. Hence, we call it the fear gauge. You come into your trading desk in the morning, ask the market how it's feeling. It's going to say, check out my VIX. So you pull up the VIX and that's going to tell you what the market's doing. Guys, thanks so much for tuning in. Remember, in the world of options trading, every choice counts, and we want to make sure that we're selling and buying at the right time based on that VIX. So if you found value in today's content, please don't forget to like, subscribe, and share with a fellow trader. Until next time, happy trading.